Most of modern finance operates entirely in the abstract. Millions of investors spend their days buying and selling digital illusions, numbers flickering on screens that represent complex derivatives, tech valuations, and corporate debt. This chart shows the fragility of that system. When a true crisis hits, the traditional pillars of a portfolio, stocks and bonds, tend to lose their independence. They correlate, meaning they drop together, leaving those digital portfolios with nowhere to hide. But there is an asset class that exists outside this digital vacuum: commodities. They offer an entirely different kind of diversification because they are the tangible, physical building blocks of the global economy. A CEO cannot issue a press release to manufacture more copper. Corporate earnings do not dictate the yield of a wheat harvest. The value of these assets is forged by raw, unfiltered forces: rainfall, soil quality, and international border disputes. To allocate capital in commodities is to step out of the spreadsheet. You are betting on the absolute baseline requirements of human civilization. That brings us to the first major pillar of this market: agriculture. This sector is entirely beholden to the thin layer of topsoil covering the Earth's surface and the weather patterns immediately above it. Because these crops require highly specific climates, their supply chains are intensely fragile. A single regional drought or a localized fungal disease in a major growing zone can instantly constrain the global supply of cacao or coffee. But while supply can collapse overnight, demand moves like a glacier. It is driven by massive, unstoppable demographic shifts. In nations like India and China, rising household wealth is driving a shift away from traditional grains and toward animal proteins and dairy. As disposable income increases, populations naturally consume more calorie-dense diets. This permanently locks in a higher baseline demand for livestock, dairy, and the millions of tons of basic grains required to feed those animals. Trading agricultural commodities, therefore, is a financial wager on a very simple equation: the physical carrying capacity of the planet weighed against the accelerating growth of human appetite. The second pillar takes us from the renewable surface of the Earth to the harsh, immovable reality of what lies beneath it: metals. Here, we transition from the renewable surface of growing crops to the harsh reality of extracting finite resources from solid rock. This illustrates the law of marginal cost in mining. The physical cost of labor, machinery, and energy must stay below the static market price of the metal. The moment extraction expenses cross above what the market pays, the operation shuts down and supply stops. While precious metals like gold operate partially as a psychological safe haven, hoarded during economic panics, industrial base metals live and die by actual manufacturing demand. Industrial demand is now competing with the requirements of a low-carbon energy grid. The global economy is attempting to wire itself for electrification. This table outlines primary applications for base metals. Notice the demand vectors for copper and lithium. Replacing fossil fuels requires pulling millions of tons of these metals from the Earth. But expanding mines requires clearing forests and risking severe pollution. This environmental damage invites heavy ESG regulations, threatening to choke off the very supply chains needed for the transition. The metals market traps investors in a physical contradiction. To fund technological progress, you must financially underwrite the tearing up of the Earth's crust. The third pillar is energy: coal, natural gas, and crude oil. These are the combustible forces that physically keep the lights on and supply chains moving. Unlike a harvest dictated by rain, energy supply is highly engineered. Production quotas are negotiated by cartels and restricted by international embargoes. Geopolitics, rather than pure free market extraction, sets the baseline availability of crude oil. But extracting the crude is only half the equation. It has to be processed into a highly usable format, and that creates an intense industrial bottleneck known as refining. This illustrates the crack spread, the profit margin captured by purchasing raw crude and selling refined gasoline. Refiners are squeezed from both sides. If raw crude prices spike, but a weak economy prevents raising retail prices, that central profit margin gets completely crushed. Navigating energy commodities means walking a tightrope. You are balancing international power plays at the wellhead against razor-thin industrial margins at the refinery. agriculture. Metals, energy. These three pillars offer a uniquely low correlation to stocks and bonds for one simple reason. They are chained to the physical world. That physical anchor provides a vital shield for a financial portfolio, but it comes with a trade-off. You are swapping out abstract corporate risk, like a bad earnings report or a CEO scandal, for unpredictable planetary risk. To actually understand commodity pricing, you have to look past the candlestick charts and the digital tickers. The real metrics driving value here are shifting global weather patterns, engineering breakthroughs in deep shaft mining, human rights standards in supply chains, and Middle East power shifts. The commodity market represents the physical limit of human growth, the raw material that determines the scale of our survival.